Hey guys, Mike here. Today we get to answer all your questions and comments, and you had some good ones there, so we're going to get right into them. Feel free to participate. Please hit that thumbs up. Helps people find the video and everything. And as usual, let's get right into it, because small caps definitely is the topic of the week, that's for sure. And the first question here says, hey Mike, why is Tom Lee saying that small caps will rise 15% in August? What in the world would cause this? And there's a lot of stuff that would cause this, according to him. So let's just, if those who don't know, let's hear what he had to say really quickly here.
That's right. I think for the month of August, small caps can do something more than 15% even because they've underperformed so dramatically. And the type of move we've seen just in the last 2 weeks is something that only happens at the start of a pretty significant advance for small caps. But now, Russell 2000 has an 11 median PE, earnings growth 800 basis points faster. And, it just posted 11 days where 10 out of 11 days had a 1% move. The 9 times it did that since 1979, when you weren't in a bear market, we were up 100% 1 month, 3 months, 6 months, 12 months later. 12-month average gained 40%.
And it was really shocking. If you pull up IWM and QQQ, you can see right here, we'll go down and hit year to date, that they're only 3% apart. The Qs, even as much as those mega caps have run, are only up 3%, which is kind of shocking, right? And when you look at this, you have to understand the IWM is just completely manipulated, right? The stocks on there are. So this ain't about earnings. And yes, I've said for a factual record, a third of them are unprofitable. Most of them probably need to be bankrupt. But you got to understand, when you have small caps, which a lot of them I've showed you, have 25 million shares, 50 million shares, and low floats, right? Being highly shorted. They can move. And that's what he was talking about. I don't know how many days he said there, 1% days in a row and all this crazy mess. But that's why you see the IWM move up. It doesn't move. I mean, he's saying earnings, but look, market don't give a crap about that. How many times we've seen meme stocks which have negative earnings, should be bankrupt, everything else, or some that are going to file bankruptcy, just fly, right? It's not about that. This ain't a fundamental, like long-term type trade or anything like that, or long-term investment. These are totally different kind of stocks than you would see. And when you're talking about mega caps and mid caps and all these other companies who actually do get somewhat judged on their financials. But I mean, look at Tesla. Look at the run it had. Was that based off what you saw in earnings? No. That was based on, oh, wait a minute, they're going to sell robots in 2026 and AI and all this other stuff going on. They're going to have robo-taxis in August, now pushed to October. That's what that was about. Okay, so it isn't the financial stuff that actually moves stock until you report earnings. From earnings to earnings, it's a whole different thing that moves those stocks. Okay, so just understand that. So when you see the IWM running like crazy, it's running up 3 times now in the last like 12 months. It wasn't because their earnings got any better. Right, he'll put that out there, but that's just, we all know when you look at charts, that's not what moves IWM. Okay, so hopefully that helps. Hopefully you understand what he's talking about and everything. He also went in and talked about Trump being president, how that would help with regional banks and all this other stuff. So maybe that's got something to do with it as well. But I didn't bother putting that part in there for you. Now, next one here says, towards the end, you mentioned the 50 moving average. What are the most important time frames to watch the 50? It's mentioned by several traders. Of course, there's many others. Maybe shed some light on what you feel is the most important moving averages. Well, the most important, and it depends on what time frame you're looking for. I mean, obviously, if you're looking to try to get an investment for more in the day here, one's the 5-day moving average is a big one a lot of people look at. When it's sloping down, not good. Right? When it's flat or it's curling back up, that's a good thing. It's one of the first moving averages you need to see indexes get above before you're looking at them moving up, or if they get below them, it's a signal to say we might be moving down. And when it starts to flatten out, you say, oh, we're about to curl, maybe heading back up. So the 5-day moving average on the daily is important. You look at the 50 and the 200. These are the big ones, right? Things start with the 50, they end with the 200. There's a saying, nothing good happens below the 200. That is a fact, all right, whether stocks or indexes or anything else. But the 50 is where it starts at. And it's not so much about it breaking a 50. It's about the retest on the way back up. Okay, it breaks here, it retests, fails, drops, comes back up, retests again, fails, drops. That's what you're looking for. So the 50 and the 200 on the daily and the weekly as well. I mean, if you want to look at it on there as well, but especially on the daily. So I look at that right there. That's what I'm looking at. If you're talking about investing, if you're talking about trading, I mean, swing trades for longer term swing trades, sure, you can look at this if you want to. A lot of people are going to use way different moving averages than that. And so, and the big thing about the 50 and 200 is looking for the golden cross and the death cross. All right, I've showed you this many times before, but that's what signals right here is the death cross, right? You're going down, all right, because you rarely get them. If you look, you rarely get these death crosses on the indexes. You get them more on the stocks, not so much the indexes. Okay, you can see going all the way back to 2017 how many you got right there. Not many. And then you get the one golden cross coming out of the crash. So that is something big, big to use these for. They don't signal the top. They don't signal the bottom. They just basically give you that signal saying, oh, okay, money's going to start flowing into this stuff. Algos are fixing to really get kicked in. And you see it the same on stocks. I showed you it on Tesla when it has golden crosses. When stocks have golden and death crosses, it's the same thing. So keep up with that one. Another one to look at as well is you got to understand what stock respects what moving average. If you look at the 21 here on NVIDIA, you go back on this run it's been on, it really respects the 21. And when it gets below it, it is not good, okay? If we come out of the 2022 crash and we started going that run, what do you see it doing? It's just bouncing right off that 21. If you just kept buying as the bounce off of 21, you were doing great. Here we go, consolidation, heading sideways, getting beneath it, but then it starts to run back up, and what's it doing? Just bouncing off that 21. Bing, 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 and then here we go. Fell below, retest, failed, and then kept dropping right there. Came back above it, successfully retested to the upside, and took off, right? And then when we look at what's been happening recently, obviously it kept bouncing off of it, moving up, and then what happened when it got below it? It fell below it, retest failed, and then down we go. All right, so you have to find out what moving averages work for what stocks. Like the 200 does not work for Microsoft in an uptrend. It never touches it. Apple does. Okay, so hopefully that helps you out there. Now, next one here says, could you take another look at Celsius, wondering where you think the bottom is since it reached a 52-week low? Remember, this is a momentum stock, okay, for sure. I've showed you that many times. And the first thing that's played out so far, not all the way to the bottom of it, is this double top, right? Now, their target down here is right around where that support is, between like 35, 36 right there. But that don't mean it has to play out down that low, okay? You see it trying to move up on that trend line right there. Right now it's getting rejected, but this is straight up momentum, and you have to pull up your momentum indicators to be able to see this, okay? So RSI, stochastic is what I like to use. Some people like to use the MACD, but when you look at this right here, you can see there ain't no momentum right now in this stock right here, okay? You want the bulls in charge, means you want it above the 50 on the RSI. I like the stochastic around 80 on these kind of stocks in combination of the RSI being above the 50. That's when you get big moves. Right now, it's kind of in the toilet, right? The momentum can pick up quickly. It is way down there for sure. And when you really look at this, again, it has to get above that trend line. You need that RSI above 50. That don't mean it's the bottom. You're going to be catching it when it actually has major momentum. You're not going to be catching the bottom if you do that, okay? So again, not financial advice. Do what you want to do. Bottom fish it if you like. But when you look, the real support, if it continued to drop, is going to be somewhere around like that 34, 36 range right there, that white line I got drawn there. That's real support if this continues to go down, right? Even though we're coming in a time where we could have, bullish momentum in the market come back, which means Celsius could come back as well. And right now it has come down, drawn liquidity and a daily fair value gap down there. And so that's a good thing that it did draw liquidity. But the first thing you got to do is get above that trend line. All right, that's the first thing. And then look at your momentum indicators. Now, last one here says, can you please do another video on quantitative tightening and the effect on the market as well as possible forecasts as to when it will finally end? Could you also explain the difference or similarity between QE and reverse repo? And I'm not going to do a whole video on this, but let's just go with QE versus QT here. And of course, QE is when quantitative easing, right? It means it's basically easier to get money for companies, people. It means rates are being lowered. That means the balance sheet is not being ran off. Maybe the Federal Reserve is buying bonds again and all that fun stuff. And mortgage-backed securities, right? Credit's easier to get. Bond market looks great. That's QE. QT is the opposite. The Fed funds rate, or what you may know as mortgage rates and all this other stuff, are going up. It is harder for people to get money. It's more expensive for people to get money. All right. And that starts to slow down the economy. All right. And when you look at it here, you can see we'll put the Fed funds rate and the market up right here, as you can see. And if you go through these tightening cycles, which we always go through, you can see when they're tightening, the market can still go up. But what really happens a lot of times, it kind of gets range bound. You can see right there, right? It's not that it's not moving. It's not that it's not going up, but it's going to be more volatile, right? There's a 20% drawdown from 2018 and 2019, starting October, December, right? But you look, went up 23%, took 612 days. But look what happens when they started actually. And if you look, a lot of that move happened when they paused. You get these pause rallies, as I like to call them, because then you get the anticipation of the cuts. That's what we're going through right now, right? The quantitative easing. Look what happened when they started to cut, though. Look how much this market went up just on the cut. So you're talking about, well, I just showed you, which took about 600 plus days. Now you're talking about an even bigger move of around 26% and 221 days, a third of what it took when the tightening cycle was happening. Okay, that's why Trump was just railing on the Fed president to cut rates, because he knew it was slowing down the economy, slowing down growth, and which would affect the stock market, right? You look back here before the '08 crash. They start raising this up. Remember, we're coming out of a dot-com crash that lasted like 3 years. What happens? It goes up all right, but not really. Look at that. From the time they started to the time they ended, it's down 4%. They just stayed in this range. Then all of a sudden they pause, boom, and then they cut. Oh boy, right? And you see this big move going on. All right, so we're seeing the same thing now where they've been pausing, the market's been going up while they paused, and all of a sudden it's like, woohoo, they're going to cut. So we're in this anticipation of a cut, which they consider easing. It ain't even happened yet, right? But it's the anticipation of it and all that fun stuff. But what quantitative tightening actually affects more than anything else is this right here. And it's the business cycle, right? These are like new orders, for example. This is what the lifeblood of the economy is. You know, people are expanding, new orders are coming in, they're increasing, people are hiring, blah, 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 getting raises, loving life, increases in their 401k. And you can see, here's the tightening cycle, and you can see what's been happening in new orders. It still ain't recovered, still sitting in contraction. That's beneath that white line. You look over here, when you look at the 2016 to 2018-ish hiking cycle right there, and you can see, look what was happening. There's where the rates start to take effect, and look what happened in new orders. And this is when Trump was going off on it, off the Fed president, saying, you got to lower rates, you got to lower rates, you got to lower rates, right? And I showed you what the stock market was doing, right? But this is a key sign, though, when you look at this, that the market is not the economy, and the economy is not the market. And you'll see this even better right here. During the '08 cycle, right here, you can see it. They're hiking. Look at new orders. I mean, just totally declining, and things are slowing down. But you can see it still didn't go in contraction. Okay, still didn't go in contraction. And I showed you when the market really started to move, right? And so this will show you rates will take effect on the economy, the business cycle, much more than when it will come to the stock market. And I'll show you, I'll talk to you why about that in just a second. But here's what the market really cares about, the stock market, that is. I put this in the Patreon every week and in our Discord. It is financial conditions, right? And are they loosening or tightening? Okay, credit and all this fun stuff. Well, the reason why the market's been going up, no matter what's been going on with inflation and stuff, is because it's been loosening, right? Even though they've been raising rates and stuff, there was so much liquidity in the market that the Fed put out there with all those checks and everything that it's still loosening. It's still easy to go out and get money and all this other crazy stuff. The banks are still lending, which is kind of crazy. You know, even though that's kind of dried up on the home mortgages and everything else. And then when you look at liquidity, it cares about liquidity. They don't care if it's going up and down. It can go sideways. Okay, I shouldn't say don't care if it's going up or down. If it's going up, the market's really on steroids then, which you can see right here when it's going down. This is 2022. When it's going down, it was going down before the crash. They don't like that. Okay, they don't like liquidity going down. That's when they were really trying to drain out all this liquidity they did. Market goes down. And it almost anticipates this, right? But when you see here, boy, look at that. Loves it when it goes up. This one on steroids. This is when the Fed just pumped all that money. And the government's like, here, free checks for everybody. Woohoo! And the market went on steroids. But you can see, it's basically been in this same range for over a year now. That's what it really cares about, just stable liquidity. It does not want to see it drying up. Doesn't want to see any kind of financial conditions tightening, all that fun stuff, and it can go to the moon. And the real, like the big reason, I mean, and you can go back and look at this, like during one of the greatest bull runs ever. Just look at that, how stable it was right there. From 2014 to 2018, the beginning, then when it started to tighten, what happened to the market? 20% crash. Okay, didn't like that. Then look right here. Starts to go up, but basically just stable. And guess what? Market moons. Okay, it loves that kind of stuff. And when you pull up the Qs over it, you can see exactly what I'm talking about when you compare this, okay? You can look at it yourself and see that. Stable, we're going up, going down. It has one little last pump, 20% crash down, stabilizes again, and we have this crazy moon up going into 2020. And you can see if we take it back even farther, you can see the same thing happening between like 2004, 2015 right there. Again, it's the liquidity's coming up. Market's going up, recession, all of a sudden Fed comes in, has to rescue banks, everything, liquidity spikes, goes to the moon, and we have one of the greatest runs we ever had, because he had zero rates on top of just record amounts of liquidity that the market had never seen, okay? But the truth is, the reason why the market goes up, because it always finds a way to go up. What did it do this time? It just concentrated into like 7 stocks for the longest period of time, right? We're just going to push NVIDIA, Tesla, actually not even Tesla got killed, but Google, all these AI stocks, Microsoft, Apple, Meta, all these other ones. We're going to push them up and the market just goes up. And you saw for a long time, breath sucked. And all of a sudden they really need it. They go, let's get the breath in there. And then that pushes it up, okay? So it's not the economy. It waits and sees and goes, ooh, okay, now the economy is really sucking big time. We're in contraction on all this other stuff. And now we'll sell it off, right? In 2022, they thought there was going to be a recession because, as I did a video last week when I was on vacation, put it out for you guys. Make sure you go and watch it. I'll link it at the end here. You saw what happened. A lot of the indicators were flashing recession, and they said, let's just get out early now, ride this puppy down, and then they'll come in. The market will start to go up before the recession ever ends. That's the way it is. The market always bottoms before the recession ever ends, okay? And so that's the way it works. So that's why I keep telling people, and they're fascinated, go, I don't know how the market keeps going up. And that's what I put out every week. Is liquidity good? What financial conditions are doing? Is there anticipation of a pause or a cut or anything else? That's what matters more than anything else on this. And then when we hit earnings, if they disappoint, they'll just sell it back down, buy a cheaper thing, and then run it back up, right? So just put that out there to you. Hopefully that makes sense. I appreciate all the questions. Feel free to put more. We'll put them in next Saturday's video. And I always love reading your comments on this stuff and getting your input, because people sometimes disagree on this stuff. So, and I like to read those kind of comments. So anyway, hope you got something out of it. Please hit that like and subscribe button, and I'll see you guys tomorrow to set up the week.